Well, good evening, everyone. It's great to be here. Feels a little bit weird because I guess you can see me, but I can't see any of you. But hopefully we'll have an interactive session toward the end of this presentation. And as Damus mentioned, my background is in computer science. I kind of fell into finance by accident because I happened to do my master's with a professor in finance who did a lot of cross-disciplinary work. And so I tend to think of what AlphaLab does as being at the intersection of tech and finance. So going on to the presentation then, sorry, let's see here. There we go. Are you, I guess, Damus, just checking everyone can see things fine? Are you able to see things fine?
Yep.
It's not. Okay, great. So who is AlphaLab? AlphaLab was founded in late 2017, early 2018. And we started out being algorithmic traders in the cryptocurrency space. And this was back in the days of the ICO boom, the first crypto boom. We saw just a lot of pricing inefficiencies and discrepancies back then in the crypto markets. I was interested in throwing up some strategies, built something over the course of a weekend and a week, and deployed them, and they ended up working really well. And that became kind of an organic start to the company. Today, we've grown quite a bit. We trade billions of dollars every day in the crypto markets across both centralized and decentralized exchanges. We have about 40 plus employees, and we're still growing and hiring quite aggressively. Our headquarters in Singapore, but we also have offices around the world. And we've recently branched out into investing in and providing liquidity services and market making services for new crypto businesses and protocols. And this leads to the topic of this presentation, which is what exactly is market making? A lot of firms use the term quite differently depending on the context. Some firms use the term as an official designation by an exchange. Some firms use it as a type of strategy. For us, market making is really the act of providing liquidity to a market. And when we say a market is liquid, it just means that you're able to do what you want to do. So in this case, transact whenever you want and in the sufficient size that you want. So I think oftentimes when we're talking about finance, people find the concept of market making very abstract because I think financial instruments are often a layer of abstraction removed from the real world. So I think it's often helpful to illustrate this with another example that we might be all familiar with, ride sharing. And I can sort of describe the concepts alongside each other, alongside crypto trading. So when we talk about a liquid market, we're really saying in the context of ride sharing, it's that when you book a ride, you can find one right away. And that it's close to you and the driver can come and pick you up quite quickly. So basically you can imagine there's a fleet of riders just waiting for, or sorry, a fleet of drivers just waiting for riders to make a request. And in crypto trading, it's very similar. And I'm assuming people here are at least familiar with transacting somewhat in the marketplace. So you're essentially able to buy or sell the instrument that you want to in the sufficient size that you want to, whenever you want. And so we've kind of all experienced somewhat illiquid markets. I think within Singapore, whenever it rains, it's really, really hard to find a driver without paying a huge surcharge. And there's a reason for that. So, and we'll talk a bit about how that contributes to the marketplace and ride sharing. So, so when we think about markets today, Grab is great. You know, you can order a car almost in time. But when it started, how do you actually create the market? And I think that's what market making does. It sort of creates one side of the marketplace. So in the context of ride sharing, it could be that the marketplace itself really just buys and operates a fleet of cars, or anyone really buys and operates a fleet of cars at the ready for essentially riders to book. And in crypto trading, and in sort of I guess financial marketplaces in general, market making basically implies being at the ready for other people to transact against. And I'm assuming people here are familiar with the concept of a central limit order book. So in this case, what that means for a lot of centralized exchanges is to post liquidity into essentially post orders to buy and sell in sufficient size, such that if someone wanted to come in and buy and sell against your resting limit orders, that they can do so. So we can think of different ways that one can incentivize liquidity in a marketplace. So I'm going to, on the left-hand side, I'm just going to go through some of that as it relates to ride sharing. So for example, Grab and Uber, they did this when they were first starting. They basically helped to finance cars for drivers. They would hire fleets, and they would essentially incentivize people to be able to operate their own fleet as well. And the crypto equivalent of that for an exchange is you essentially hire a professional market making firm. So for example, crypto exchange might come to us and say, we would like to have more liquidity on a particular trading market, and make it and engage with us and say, can you do this? Can you make sure that within 1% of the current mid price that there's sufficient liquidity to transact, or that the difference between the best buy price and the best sell price is never more than some amount. So people call that the bid-ask spread. So essentially that there is a tight bid-ask spread, and when you look at prices between the best buy and best sell, they're not too big apart. They're not too far apart. Grab and Uber might also, for example, incentivize drivers with bonuses to reach certain milestones. So for example, if you've done a certain number of trips, you would then get a bonus. So it sort of incentivizes in this case, the drivers to be at the ready for when riders try to book. And in the financial world, exchanges will often make use of a rebate structure. So what they will say is that for people who provide or put in passive orders, essentially giving others the optionality to trade, if your order is executed, the exchange will actually pay you. Whereas essentially aggressive orders, or orders that remove liquidity from the marketplace, the sender of the order will pay the exchange. So in this case, it's not unlike essentially what happens for ride sharing. You would pay Grab, and Grab takes a cut, but takes a portion of that and pays the driver. So a lot of crypto exchanges will adopt a rebate structure, and the idea is to incentivize market makers to participate in their marketplace. And lastly, this is perhaps the really, really important part. For ride sharing, really the most important thing is to make sure that there are riders, right? And if there are riders, naturally there will be drivers around. And if there are riders in sufficient size, a lot of these incentives that you initially have to put in place to bootstrap the marketplace to get us started do not need to be there anymore. And similarly for a financial exchange, it's just to make sure that there's enough natural traders, there's enough natural people who want to be there and who are naturally incentivized to interact with each other on that exchange, to transact with each other on that exchange. So that's how you really get a marketplace going, right? In the ride sharing example, drivers need riders and riders need drivers. You need both sides of the marketplace. And with financial exchanges, buyers need sellers and sellers need buyers. And with more and more natural participants, the need for dedicated market makers decreases. So today, for example, I think back in the day, I believe when Grab and Uber were sort of having their war in Singapore and before they consolidated, you could find a lot of really good deals, a lot of cheap rides. And those were all actually financed by a lot of venture capital dollars, giving riders good deals. And today, after the market has consolidated and after the marketplace has sort of become more organic, a lot of that probably has disappeared. And within crypto trading, traders just go where there's natural liquidity and a lot of orders to trade against, and the exchanges stop having to give so many incentives to market makers. There's always a balance because there's always competition, but that's usually sort of the path of how marketplaces develop. So in summary, the value add of market makers is twofold. In the beginning, they really to help to bootstrap a marketplace in part, and sort of solve the cold start problem. So this is, you kind of see this, as I mentioned, with exchanges that work with market makers to help launch new markets, or even cryptocurrency token projects. Often they will find a market maker to create a marketplace for their specific token, either across an exchange or within a centralized liquidity pool. And then the second function, so that's more at the start of a marketplace. The longer term functionality that market makers bring, or the value that market makers bring, is that they really allow participants to transact either faster or cheaper than otherwise possible. So one might ask, sort of, how do market makers make money? And I think I've covered a little bit of that. One is direct payments from the exchanges and token projects. Second is kind of this natural rebate structure from exchanges where you get paid in order to be passive. And then the last part is this idea of capturing essentially the difference between where you buy and where you sell. And that's typically called the bid-ask spread. So basically, if I, as a market maker, bought, let's say, Bitcoin at 40,000 and sold it, let's say a minute later at 41,000, I've just made that $1,000. And if I can do this often enough, within the span of a day, there's a good amount of profit to be made from that. The key, of course, is it's never really that easy. So this gets us to the next part, which is how do market makers lose money? And in this, there's basically this concept called adverse selection. And that's when an informed party comes and trades against you and causes the price to move essentially against the market maker. So for example, in my previous example, if I just bought Bitcoin for $40,000, and then it started going down to 39,000, well, I've just lost $1,000. And so usually what you see with these very informed people who transact is that after they transact, the price will often move against the market maker. So it's often the job of the market maker to differentiate what we call informed buyers and sellers from people who are just doing it because they need the liquidity. People we call uninformed buyers and sellers. And so when you think about this, what that means is that when market makers lose money, they need to adjust, right? They need to sort of make their quoting widen their bid-ask spread. They need to be more conservative in perhaps how much inventory or how much risk that they can take on. And this is why a lot of regulators actually have issues with the act of insider trading, is because it's bad for markets, and it makes it so that market makers have to widen their pricing and make it more expensive basically for everyone else to transact. So there's these adverse consequences in the marketplace that percolates through insider trading. And when that happens overall, it makes for a less healthy marketplace. So because we work in the blockchain world, especially in the past couple of years, there's been a lot of innovation within the decentralized finance space. So for those of you who are unfamiliar, basically the blockchain, you can kind of envision it almost as a global computer. It's this set of computers that work in concert to keep a centralized, well, not centralized, but a consistent store and a consistent ledger and database for everyone to read. And on top of this underlying framework, people have built what are called essentially these automated market makers. And the automated market maker, the first one that really took off is this exchange called Uniswap. And what they have is essentially this pool of capital that people put value into. And it creates a marketplace for transacting from one side or one currency in the pool to the other currency in the pool in a formulaic way. So whereas before I mentioned that market making was an activity where the market makers need to differentiate between informed and uninformed players and attempt to essentially capture the bid-ask spread. The automated market makers in the decentralized finance space deal away with all of that. So they don't care about capturing the bid-ask spread. They very much just care about presenting a formulaic way for people to transact. And the formula basically is something where the quantity of one instrument, in this case, in my example, ETH, times the quantity of USDT is always equal to some constant. And the expectation is really that this thing's going to lose money based purely on the trading. People have come up with a clever marketing term called impermanent loss, but rest assured, it can be quite permanent. But what these exchanges do is they actually just charge a very high fee. And they, I think Uniswap charges somewhere around 30 basis points, which is 0.3% for every transaction. Whereas if you look at normal fees on centralized exchanges, it can be as low as 2 or 3 basis points, and even lower than that, depending on your trading volume. And in this case, the fees that are collected are used to basically pay back into this pool of capital for supplying the ability to trade. So here, it's not unlike the rebate structure that we kind of talked about in centralized exchanges, where people who take liquidity pay a particular fee, and then that is passed on to the capital that provide this liquidity. And in this case, it just happens to be that the fee is high. That said, these automated market makers really have created a very central, what we call piece, a reusable piece that have enabled a whole host of other applications to be developed on the blockchain and really spawned kind of what people call DeFi summer and the sort of DeFi boom. So that, you know, that's a very brief overview, I think, of market making. There's a lot of nuances. And one thing I wanted to talk about here is this idea of non-fungible tokens. So non-fungible tokens are kind of a class of individually unique tokens based on a particular standard. And so a lot of you might have heard about these things. Basically, they can be used to represent the actual image. In this case, is Bored. I think Bored Ape Yacht Club. So a lot of people treat it as a store of value and a collectible. And they essentially like to buy them and hold them or transact in them. There's a lot of interesting nuances. Usually NFTs are come in a collection, and within the collection, there's a collection of say 10,000 or 8,000, however many different pieces, and within the collection, the pieces have different characteristics and rarity, and but they're in some ways similar to each other. So I thought one thing that could be a little interesting mini exercise for people to kind of think about and apply some of the concepts that they learned in my presentation would be to consider, well, what does it mean then to market make for NFTs? So with that, my presentation has ended, and I'm happy to kind of take questions both around the mini exercise as well as any other questions that you might have. So, Damus, how should we go about doing this? Should I just start answering the open questions?
Yes, I believe you can start off with this question first.
Mm-hmm.
All right. So basically the question would be, most forex brokers provide two types of spread. Some fixed spread while paying commission fees, whereas another will be variable based on current spread. So why aren't crypto brokers offering fixed spread? Is it because it's too expensive?
So I guess in this case, I'm not entirely sure what they mean by a fixed spread. So does that mean zero spread, and then they just purely take a commission? So I guess in this case, the term fixed spread is a little foreign to me. Typically, my experience with most forex spaces, hold on, let me see. Yes, or sometimes 1 pip for, let's say, your USD. Right. So I think basically the foreign exchange markets are a lot less volatile than crypto markets. And frankly, it's also the maturation of the space, right? So when there's a lot more competition, a lot lower volatility, people have different models for charging. So some people might come to you and say, we don't charge you anything, and we just give you a price. But in reality, they're secretly charging you a bid-ask spread. Like FX people do this all the time. And then some might just outright charge you a commission. And if you impute what the commission rate over the amount that you transact is, usually this is for small like retail amounts. It's actually quite high because the commission might be like $10 for $20,000 worth of transaction, in which case, when you calculate that, it's in the basis point. So it's not actually lower. But within crypto, I think a lot of it is just that I think, and actually to be fair, there are those models if you deal with individuals or what's called OTC, but oftentimes with centralized marketplaces, even in FX, everything's based on bid-ask spread or plus a commission. So I think the fixed spread tend to be more retail focused as opposed to professionally focused. So I have another question. What made you interested in the blockchain industry? That became, so the question, can other people see the questions or should I read them out loud?
I can read out the questions.
Got it. Okay.
Yep.
So here's one. What made you interested in the blockchain industry that became a deciding factor for you to explore and stay in this industry? Yeah, so when I first started in the industry, it was just purely that the marketplace was very, very inefficient. And to be completely honest, in the beginning, I actually had my doubts about the utility of the industry itself, because at the time, a lot of people used ICOs to essentially raise a lot of money and didn't do anything with it. And it was all just, it was sort of like gold rush. And you had a lot of very interesting actors in the space. And so in a lot of ways, the only real product market fit at that point in 2018 was speculation. So it was speculation and hype and fundraising, basically. And there weren't really other very useful applications that I was aware of. but as it turned out, I kind of threw the baby out with the bathwater, and there were actually really legitimate people that were, hankering down and building real products that people just weren't aware of at the time, I think. And what ended up happening is in toward the end of 2019 and 2020, a lot of these really started to take off. And unsurprisingly, it kind of took off around the same time that COVID happened and global central banks started lowering interest rates. But regardless, what ended up happening is prices of a lot of crypto instruments went up. You saw adoption of real products. And granted, a lot of the use of the products are driven by very high returns and very high sort of yields in the space. But the net effect of that is it brought a lot of very talented and very serious people into the space. And you're starting to essentially see an ecosystem and a lot of the Lego blocks of a parallel financial system develop. And because the space is still quite unregulated, and you basically have a lot of, I guess, nerds experimenting with real large sums of money in a way that it's just not possible in a more traditional financial and very regulated space. So there's tons of experimentation going on where people are playing around with new incentive structures. And so it's really at the forefront of, I think, development. And that's really exciting to be a part of and really exciting to sort of engage in. So yeah, that's that. Hopefully that answers that question.
Thanks, John. All right, moving on to our next question. Is there a methodology to price NFTs?
Right. I think there is. Oftentimes NFTs are part of a collection. And so you can come across it from a few different angles. So I can maybe think of a theoretical one, which is that, why does gold have value, right? It's because it has this history and it has this community and people kind of agree that it has value, but really you can't drink it, you can't eat it. If the world went to hell, you can't really do too much with it. And same with NFTs, right? People kind of talk about, well, what's the value of NFTs? You can always right click and save the picture. But it's really around this community of people around a project. And within this community, people adopt the convention of it as having value. And so what ends up happening is this community focuses first on projects. So within a project, there's often a lot of relationship between how the price moves. So what that means is you can price a single NFT off of what the pricing or the transactions are of other NFTs. So it's not unlike real estate where you look at comparable transactions in the surrounding area or of similar units, and you sort of make a price on yours. Then within a collection, you can also look at things like rarity. So how many of these apes are wearing hats, or how many are mutant apes versus normal apes? And so the idea being that when things are more rare, they tend to be worth more. But these are sort of, there's not necessarily a theoretical basis for it. It tends to be more of people kind of all believe in this. So ergo it happens. So that's kind of the reflexivity that you see in financial markets often, that what people believe actually turns out to be true, not because it should be true, but because people believe it.
Okay. Thanks, John. All right. For the next question, we actually have a few people asking about it. So it's essentially about whether AlphaLab is actually going to hire interns, and one of them wants to find out whether, particularly in the DeFi space and not just for software engineers.
Right. So the short answer is yes. We actually do have a sort of DeFi analyst intern. So we do hire a lot of software engineer interns. And in fact, the software engineer interns work in DeFi. But our sort of general idea is that the blockchain is fundamentally a very technological space. So having a tech background or being tech savvy is tremendously helpful to figuring out what's going on, to interacting with the space. To even modeling out potential outcomes. So the answer is yes. We just feel like the successful applicant usually has a degree of technical savvy that needs to be demonstrated.
All right, thank you. So for the next question, what kind of coins does AlphaLab trade?
What coins? Pretty much anything with liquidity. So we trade maybe the top, I don't know, top few hundred. So yeah, it's very hard to enumerate it all, but we trade a lot.
Okay. So what do you think about market making for DeFi 2.0? And how does it fare against traditional market making and or centralized market making?
Right. So again, people use the term DeFi 2.0 differently. I guess in this case, I'm assuming they're talking about like an order book based sort of system, but implemented on the blockchain, or maybe someone can sort of respond to that. But if it's within the automated market maker framework that I sort of talked about, then there is no market making, right? You market make by providing liquidity to the system that then uses your liquidity to market make for you based on a formula. So there's no skill necessary. You simply deposit capital there. So in our trading, we're one of the people that keep the prices in line between the different liquidity pools in the DeFi space. So across different blockchains, within centralized exchanges and so forth. But if you're talking about sort of so for example DYDX and on Solana, there's a Serum sort of projects where it's actually an order book based market, then it's not too different. It's just that one happens to be non-custodial and on the blockchain, while the other one is against a centralized service provider. And sometimes one is more reliable than another. Sometimes it's not. And so each have their pros and cons, but fundamentally the underlying dynamics are not too different. And then there's a second part of the question, which is how does it fare against traditional market making and or centralized market making? I guess this is from the point of view of the market maker. Hopefully I've kind of answered that in the two different contexts of an automated market maker and an order book based market. So, but please feel free to recirculate the question if I haven't.
All right, sure thing. Thank you. So for our next question, why did AlphaLabs choose to base its HQ in Singapore? And how would crypto market makers be affected with the recent banning of crypto exchanges leaving Singapore?
Right. So this was back in 2017, and I would just happen to be living in Singapore at the time, right? So it wasn't necessarily a deliberate choice. It was just part of what what fit with my life. And I think within the crypto market, there's always a bit of regulatory uncertainty. I think certain exchanges, I think the Singapore government actually takes a quite considered and forward-looking approach to cryptocurrencies. And we generally view regulation as a great thing because it gives clarity where there was none. So nobody likes to operate in an environment of uncertainty. In terms of crypto market makers being affected, one thing I should have mentioned is that we don't take any outside capital. So we're not a fund manager. We're doing this all with essentially personal or proprietary capital. So long as our trading entities still have access to the markets, we are not affected. I think that's sort of the practical answer. But for us as a firm, we definitely try to stay on top of regulatory developments and make sure we're in compliance with all the said rules and regulations.
All right. So someone actually thinks that NFT market making can take place when you place offers of NFTs closer to the selling price, and perhaps that selling price of NFTs lower than the floor price, perhaps to decrease the spread. But would that actually constitute to market manipulation?
Right. So usually people, yeah, there's let me think about this for a minute. I think usually people sort of talk about this in terms of why it is you're doing something, and are you trying to mislead other people, or are you trying to actually transact, right? So in this case, I mean, yes, you can always make a marketplace by basically offering a stupid price, right? So I think you get the goal of transacting, but you lose money. So market makers who do that can't stay around for long. The question is, how do you become a sustainable market maker, right? So I can become a market maker in iPhones by selling the latest iPhones for $100 when everyone else is selling it for $1,000. But I probably won't do that for too long before I run out of money, and I'll make a lot of people happy. So I think the question here, it's a good thought, but the question here is, how do I market make and actually do it in a sustainable way? But on the market manipulation question, again, it depends on what you're trying to do and if you actually intend to transact.
Okay, thank you for that. So our next question would be, how much more risks are market makers taking by providing the market for NFTs as compared to the general market?
Right. So within the crypto space, I guess in the general marketplace, there are essentially ways to bet against the crypto markets, at least certain coins. Those are futures markets. So you're able to kind of hedge your risk and hedge your exposure when holding inventory to be a market maker. So what I mean by that is, in order for me to buy something, I, of course, just need, say, US dollars or euros or whatever it is. But for me to want to sell it, I need to already own it, right? So I'm constantly holding on to some coins just for the sake of the activity of market making and being able to sell it. So that inventory has risk. So you could be making money on the market making, but if the price goes down by half, you've still lost. And so what we do in particular is we hedge that risk by essentially shorting the futures. For NFTs, it's a bit harder. You kind of have to look for correlated things that you can take on as a hedge. So that, because in order to market make NFTs, you have to kind of hold an inventory of them. But holding onto inventory exposes you to price risk while you're trying to, say, sell that inventory. So there are particular things or instruments out there that are broadly correlated with the NFT marketplace that you can essentially attempt to use as a hedge. But it's likely to, at this point at least, to be very imperfect because there's so much idiosyncratic stuff associated with NFTs. So yes, they do take on more inventory risk, is a short answer.
Right, thank you. So for our next question, if market makers get more and more irrelevant as the crypto market booms due to natural traders, what is the direction that market makers will usually take to stay relevant in the market?
Right. So I think that's a great question. They do become more irrelevant, but not irrelevant, right? So there's a stable equilibrium, I think, where essentially you would still be there in the marketplace because the natural trading strategy itself makes profit. This is the funny thing I remember learning in econ, where it was like, oh, steady state profits go to zero. And I remember sitting in this class and thinking, well, theoretically, who would ever actually start a business if profits were all zero? But the fact is, people really stabilize at an equilibrium level of profits that's above zero. So I think for marketplaces, a lot of it's like that. And the other thing too is of course, market making, the activity itself is quite sophisticated and require a lot of investment and expertise. So the equilibrium level of profits often are actually quite good because there are these significant barriers to entry.
Okay. So for our next question, what are your thoughts on newer DeFi protocols like Olympus?
I mean, my thoughts. I think they're very innovative and they attempt to solve some of the problems that come up, right? This idea of protocol-owned liquidity and rather than just mercenary capital that flows in and out very quickly. How it all plays out, I'm not sure, because ultimately there's a lot of euphoria and interesting incentives in crypto that is great on the way up and it's vicious on the way down. So we'll kind of see how it all fares, but I don't know that I don't know that I'm smart enough to give you an answer on that. I think the system itself is quite chaotic. And by chaotic, what I mean is that there's a lot of interactions that are very hard to predict where, even minor changes in input can have very different changes in output. So I can't really predict what's going to happen. I think they're extremely interesting. Like they are all experiments in incentive design and in collective behavioral economics. So I love sort of watching and keeping on top of it. I just can't tell you what will happen to it.
Thank you. So for our next question, regarding how AlphaLab Capital makes a profit from the crypto or financial markets, and if whether you guys deploy other strategies, and if so, what kind of strategies actually work on crypto markets but not traditional markets?
Sure. Yeah. I mean, the profits come from a combination of market making and arbitrage. And a lot of it is basically about being able to predict price movements and essentially be able to trade based on those predicted price movements, but in a much more sophisticated way than what you might sort of imagine. We don't. So we are looking at longer term strategies, what we call statistical arbitrage strategies. And yes, I think crypto is very new and is much less efficient. So certain strategies that work in crypto do not work in traditional markets. One one very common thing is just yield farming. You put your money in a bank account, you earn what, less than 1%. You put it in crypto and you can reasonably risk-free earn 4 or 5%. I think that just gives you a sense of the opportunity set in crypto. And because there's so much money sloshing around, people are quite sloppy in how they transact. So you might know that this thing will cost you $100 more, but it's just more convenient, and you can't be bothered to go through the 10 steps that would let you transact a little bit cheaper. But if you're a specialized, say, market maker or our person, you can capture then that inefficiency. So.
All right, thank you. So for our next question, which are the chains that AlphaLab Capital actually backs?
Right. I think both Jump and Alameda have a strong stake in Solana. I don't know that we back any chain. We sort of transact and we interface with all of them. The activity of investing in and market making and helping new protocols or new projects is quite new. And Solana, as you know, the history is longer. So yeah, I wouldn't say we explicitly back any particular chain. Like I know Jump makes does a bunch of stuff in Solana, but the main vocal proponent has been Alameda and FTX.
Okay, thank you. So for our next question, what do you think is the future of blockchain, and would it achieve mainstream adoption?
Yeah, I think so blockchain offers a lot of different things, and I think it's important to think about what makes it attractive to most people. And I think, frankly, most people don't necessarily care too much about decentralization or privacy. Most people love convenience. And so right now, the blockchain is in a state where to interact with it is quite painful. There's a lot of frictions. You have to be willing to jump through hoops, and not everyone's willing to do that or have the inclination or time to do that. So if you look at sort of surveys of the people who are working on blockchain, they tend to be wealthier, more educated, more technical in nature. So I think in order for it to gain mainstream adoption, you really do need to have a lot more, a lot better user experience. I think one of the things that is pushing toward that trend is this sort of play to earn. Essentially, it's a way for people to, so if you think about the blockchain as a record of ownership, There is, in fact, for those of you who are gamers, there's sort of essentially this these communities that trade in-game items. And before it was always closed systems, like on Steam or whatever else, and was a bit unofficial and sometimes not supported. But with a blockchain, it's interoperable and supported across games. So that has created a lot of excitement around blockchain gaming and spawned this whole movement of sort of pay to play, where a lot of people, especially in lower wage earning countries, are playing these games in order to earn tokens that they can then sell for real cash. So that has pushed some mainstream adoption, but it tends to be through, again, a more aggregated interface of games and not so much direct interactions with blockchain all that much. So I think, yes, there is a future in which the blockchain enables a lot of efficiencies that we don't see. And it pushes innovation even in more traditional slow-moving banks. I think a lot of traditional financial companies are looking at the space and quite interested in it. But I think it'll look very different from the way it does today. It might also even be abstracted away that the blockchain's even involved, but where users will sort of interact on top of it or interface with it, but in a hidden sort of manner.
All right, thank you. For our next question, what are some of the things that move in the opposite direction as NFTs?
Well, I mean, one can imagine, for example, NFTs might be correlated to Axie Infinity, right? So you might short futures on Axie Infinity. There's something called NFT Fi, which I believe there are futures on. So essentially, there's indexes comprised of NFT projects or things tangentially related to NFT where you can probably measure some strong correlation. Whether that lasts, because it used to be that everything in crypto was very, very highly correlated. Now you see more individual idiosyncratic movements in certain projects. But by and large, there's still a lot of the market all goes up or down at the same time. So you can take advantage of that. Yeah, it's going to be imperfect, but it's better than nothing.
Thank you. For our next question, how are you able to identify if trades are coming from informed market participants?
Right. I think that's a more complex answer. And if you want to find out, apply for our internship. But the real answer is you basically look for things that predict the future price movements, right? And they come from a large number of different sources. And, you know, and it possibly changes over time. So that's an ongoing research project that forms essentially one of the core value adds or core pieces of intellectual property of market makers.
Thank you. Our next question is regarding an internship as well. So this person actually asked whether he can intern at AlphaLab with a data or crypto background.
Sure. I mean, please apply, and we will evaluate accordingly. Yeah.
Our next question: during periods of high volatility, market makers tend to widen the bid-ask spreads. Wouldn't that create even greater volatility and a less efficient market?
Yes, absolutely. And I think that's just natural, right? So I think it's been sort of heralded as a critique of market makers that they're never there when you need them. I mean, I think maybe there's some fairness to it, but it's sort of like let me think about how to make an analogy. You know, I think it's like, suppose a hurricane comes through Singapore and you really need to get a ride and there's no riders and you're like, oh no, you can never book a car when you want it. I mean, yes, that is kind of true in a sense, but it's also not necessarily fair. So I think market makers definitely do tend to widen bid-ask spreads, and it does make it so that the markets are more volatile than they normally would be. But then the question is, are they more volatile than if the market maker weren't there? So that's probably the more appropriate comparison. And, you know, people are of different opinions on this. It's also a complex topic there. Yeah.
Thank you for that. So for our next question, do you really feel that blockchain is decentralized since servers and projects are all backed by centralized entities?
Yes. So that's a great question. No, some are definitely not, and there's a lot of experiments with like DAOs or things calling themselves DAOs, but that are really kind of centralized. There's a few ways to see that. One, sort of people jump on the blockchain bandwagon, and it's sort of a great ways to raise money and get hype and attract talent. The other one, though, is that most people don't care, right? So if you, for example, Ethereum has a lot of very secure, um, uh, it's extremely secure relative to a lot of the other blockchains like Solana. In terms of privacy, decentralization, so forth, but it's very slow and its rates are high, right? Whereas Solana, it's very fast, it tends to be cheap. So what do most people care about, right? And if you have very high fees, that's exclusionary. People aren't, just are not going to interact with it. So I think this goes back to what is a core value of a blockchain, and a lot of it might be to build social consensus and social experimentation, and less so about the true decentralization. Right, or rather, there is a set of people that care about it, but how big they are relative to the majority of the population is something that it's worth thinking critically about.
Thank you. So for our next question, do you see the introduction of decentralized exchange automated market makers complementary to centralized exchange order books?
Yes, I mean, I do. I think both serve their place. Like I said, centralized order books tend to be generally cheaper, whereas decentralized AMMs tend to be more expensive, but also tend to be more convenient at times. And certainly you see things that are a little bit better, even like the stablecoin to stablecoin type of pools that Curve has. But that underwrites a lot of tail risk in case of peg breaks. So it's interesting because a lot of the blockchain is and these experiments are built on layers and layers of assumptions. And again, it's anyone's guess. Like if there's a real black swan event and sort of tether breaks or on these algorithmic stablecoin breaks, what that means for everything else, right? It could be quite bad. But right now, a lot of people just sort of, because it's such a remote event, people don't think about it. Sorry, that's more of a tangent, but yes, I do see it as being complementary. They offer their unique things. And apologize, I do have to hop off in probably a couple minutes.
All right, so hopefully we can answer the last two questions in the next 5 minutes. So for our second last question, do you have any advice on someone getting to algo trading?
Yeah, I think actually, I think definitely computer science. I think games, we're thinking in terms of game theoretical ways and strategies and probability. Stats and econ, depends on what you mean by stats and econ. It covers a broad things. I think of it more in probability because it's about scenario analysis, where statistics, a lot of it focuses on idealized distributions and so forth. But yeah, I think definitely computer science, definitely sort of probability and just sort of being interested in games of strategy like chess or poker. That helps.
Thank you. So for our last question, where do you see AlphaLab in the next 10 years as the market grows?
Oh man. Well, in the blockchain space, that's sort of like asking where we're going to be in 100 years. And the answer is I really don't know. The space is evolving very quickly, and we can sort of constantly anticipate and form our theses about the market. But there's so much information that we have to reformulate it quite often. So right now, I'm focused sort of on building teams of people who are very motivated and engaged and who are very interested in the space and making sure that I provide an environment in which they can thrive. And I think that really just given just the amount of activity and creativity in the space will result in good outcomes. So I tend not to focus too much on what the outcome will be, so much as making sure we have good processes in place and basically trusting that good processes result in good outcomes.
All right, John, I think that would be all. So,
okay.
Do you have any final words for the audience before I?
No, thanks for the great questions. Really love the thoughtful questions. And again, please don't be shy to apply for an internship or a full-time job. We are always looking to hire great talent. So maybe I will even interview you and you can tell me about how you really enjoyed this presentation. So bonus points.
All right. So I'll take over from here. Thank you, John.
Okay, excellent. Have a good night, everyone. Bye-bye.
All right. So thanks everyone who tuned in for today's workshop. NUS Fintech Month is proud to be partners with AlphaLab Capital, and we look forward to working with them in the future to speak on interesting topics again. If you haven't already registered for other workshops, please visit the links which I just shared in the chat. And once again, on behalf of NUS Fintech Society, have a nice day and see you soon.